I manage a $2 million real estate lending portfolio along with a multi-six-figure index fund portfolio. And in today's video, I'm going to give you my honest take on both of these powerful investment strategies. I'm talking about the pros and the cons, what I personally like and what you might want to watch out for. And at the end of the video, I will break down a real world example. I'll show you actual year-over-year returns from both my real estate lending portfolio and my index fund investment portfolio. So grab your notepad if you need to, because I'm about to share everything, no holding back. Let's start with index funds. Before I talk about the pros and the cons, let's get a clear definition on what an index fund actually is. If you do a quick Google search, you will see that an index fund is an investment vehicle that aims to replicate the performance of a specific market index, like the S&P 500. When you invest in index funds, you're not buying one single stock, you're buying the entire index. That means your money is getting spread across hundreds of companies, giving you instant diversification without needing to research or handpick every stock. That's already a win. All right, let's get into the index funds pros. Pro number one, passive income. The first pro I have to talk about is how passive index fund investing really is. Y'all know I'm big on passive income, and index funds are the ultimate set it and forget it investment. You don't need to be checking your charts every day. You don't have to become a stock market expert. You just invest consistently, sit back and let time do its thing. Even Warren Buffett, one of the greatest investors of all time, recommend index funds to everyday people. Whether you're just starting out or you've been in an investment game for a while, index funds require minimal management, and that's powerful. Pro number two, dollar cost averaging. This is a strategy where you invest a fixed amount of money on a regular schedule, regardless of what the market is doing. Let's break this down real quick. Let's say I buy shares of VOO at $400 a month, and next month the market drops and I buy $400 a month of shares of VOO and the shares is $300. Now I own shares, but my average cost is $350. That's dollar cost averaging in action. This strategy helps reduce the impact of market volatility, and it protects you from dumping a big chunk of cash right before a downturn. Pro number three, liquidity. The third thing I love about index funds is that the money is liquid. Now, let me define what liquidity actually is. To me, liquid means I can access the cash within 48 hours. You're not locked in it for years or months like real estate. And here's the sauce. I don't just sell my index funds when I need money. I borrow against them using a margin loan. Yep, you heard me. I use my portfolio as collateral. And that brings me right into the next pro. Pro number four, your money works in two places. With margin, your money can be in two places at once. That's right. Two, at Vertical Capital, we take out a margin loan against our index fund portfolio at 6.25%, and then we lend that money out at 13%. That's a 6.75% spread or arbitrage. It's smart leverage, and it allows you to grow both portfolios at the same time. This is some good information. So go ahead and hit that subscribe button. And here's the last major pro. Index funds is not risky. If you can manage your emotions, listen, the market goes up, the market goes down. Right now, my index fund portfolio is down by 13%. But guess what? I'm not panicking, because I understand the long game. Over the last 20 years, index funds have returned around 10% annually. That's because the risk is spread out across entire sectors, not just one stock. So if you can just hold your nerve during a downturn, you will win in the long run. Here's a quick recap. The top benefits of index fund investing that I believe are the top benefits: it's passive. Dollar cost averaging builds consistency. Your money is liquid. You can use margin for leverage, and it rewards patient investors. I personally don't see many downsides to index fund investing, but here are a couple of common cons people bring up. So con number one, market exposure. If the market crashes, your investment crashes too. In 2008, the S&P 500 dropped over 37%. Index funds are not immune to market crashes. Con number two, you won't beat the market. Index funds are designed to match the market, not outperform it. So if you're looking for a big home run, index funds probably not it. Now let's switch gears and talk about private money lending. This is where most of our capital is at, even though we love index funds. Your money is backed by real estate. Every loan we issue is secured by a physical property, which is an appreciating asset. So worst case scenario, we still have something of value back in the deal. Pro number 2, risk mitigation. We don't lend crazy. At Vertical Capital, we only lend up to 65% of the property value. That gives us a 35% buffer in case the market dips, or a 35% protective equity. Plus, we make sure the borrower brings money to the closing table. So if something goes sideways, if the market dips, if the property appreciate, their money takes the hit first, not ours. Pro number 3, consistent and steady income. Even with market shifts, our lending portfolio continues to produce stable returns. We're not doing wild flips. We're focused on reliable deals like rehabs and refinances. Let's cover the real estate lending cons. Con number 1, your money is locked in the deal. Once you commit to a loan, that money is tied up for 6 to 12 months. So if you need quick access to your funds, maybe reconsider this strategy. And remember, money is liquid if you can access it in 24 to 48 hours. Con number 2, you can't reinvest immediately. With index funds, dividend reinvest is automatically. But with lending, you got to wait for the next deal before you can deploy your cash again. That slows down your compounding slightly. Con number 3, is not passive. Yeah, we are not swinging hammers, but we are working, marketing for borrowers, underwriting deals, managing the draw process, servicing the loan, and preparing everything for closing. And the larger your portfolio, you will see these tasks can become a full-time, or eventually you will have to hire staff. But for our capital partners, it is 100% passive. If you want to invest with Vertical Capital, join the Vertical Capital community for free. The link is in the description. After you join, click the Make Money with Vertical Capital tab in the Classroom section and watch the video and schedule a call. Here's how our portfolios have performed over the past 3 years. In 2022, Vertical Capital lending portfolio saw a 22% return. In 2023, it was an 18% return. In 2024, it was a 19% return. With our index fund portfolio in 2022, we took an 18% loss in 2022. In 2023, we gained 28%. In 2024, we gained 24%. And right now in 2025, we had a negative 13%. There's a difference. One is consistent, the other is more volatile, but can offer passive returns if you stick with it. The historic data of index funds over 20 to 30 years produces 10 to 12% returns. But what's better? Honestly, it depends on your goal. Real estate lending gives you steady income and asset-backed security. Index funds give you liquidity, flexibility, and long-term growth. For me, I like both. I'm going to keep growing our private money lending portfolio, and I'm also going to keep investing consistently in index funds. Both are powerful, both build wealth, and when used together, you could gain financial freedom faster. If this video gave you any value, subscribe to the channel and leave a comment below. Tell me which one are you investing in right now. And if you're ready to start lending and grow with us, join the Vertical Capital community. It's free.